The cryptocurrency trading platform Coinbase has reported a larger than expected quarterly loss. Investors, worried by this year's fall in the value of riskier assets, have shied away from trading in cryptocurrencies. Coinbase says it also expects trading volumes to fall further in the current quarter. Well, let's speak more about the cryptocurrency and blockchain issues around this with an expert in that field, David Gerard, author of the book Attack of the 50-Foot Blockchain. David, good to have you with us. Do you think this spells perhaps the end of what could have been a bit of a honeymoon era for the crypto sector?
Absolutely. The bubble is over. The retail dollars have gone home. That's the really important number, which Coinbase didn't break out in this 10Q. But as an investment, crypto utterly depends on fresh outside retail investors' dollars coming in. And all those people have been scared off. They started disappearing in the first quarter of this year when Coinbase lost only 500 million. Second quarter, there are all these disasters. Terra Luna collapsed, Celsius collapsed, Voyager collapsed. A lot of retail investors got hurt badly on those. They've taken their dollars elsewhere. And early investors in crypto can only be paid out using cash from later investors. That's how crypto works. So the lack of retail dollars is an active, ongoing disaster in crypto. Coinbase has tried to put a brave face on it, but the numbers are as bad as they look.
Is it not cyclical, though, like any risky asset or riskier asset, that when things pick up economically, when inflation eases and perhaps when interest rates are less attractive for holding savings in dollars or other currencies, people will return and it will pick up again?
It depends what you mean by pick up, because by cyclical, they mean, is it in an asset bubble? Like, maybe it'll happen asset bubble in 3 or 4 years if regulators don't deal with the issues from this bubble. Sure. I mean, there is nothing else it can do except bubble, because it is a pure speculative commodity with no basic use case for the actual object.
And I'm just intrigued as to the effect of high energy costs, because we talk about that a lot, but of course, cryptocurrency mining in itself is a very energy intensive process because of the kind of computers they have to use to solve those equations that result in cryptocurrencies being created. Do you think that is playing a part in all of this?
Not so huge a one. I mean, the mining situation is very complicated because it would be a whole 15 minutes to explain what's going on with the miners in the US. But basically, they're feeling the pinch too, because if they have to sell crypto for actual dollars, that soaks up some of those actual dollars, and that makes Coinbase's numbers even worse. Because Coinbase are the main cashier's desk for crypto. For the crypto casino, they are the cashier's desk. So the Coinbase numbers are critical for everyone, including the Bitcoin miners.
OK, David, we must leave it there. Thanks for sharing your thoughts with us. David Gerard there, cryptocurrency and blockchain expert.